this is a very important aspect. A lot of investors typically avoid investing into equity funds because historically equities have a higher degree of volatility compared to, say, debt mutual funds. Even debt has a higher bit of volatility compared to, say, simple fixed deposit products that's there. So customers typically tend to shy away from investing into equity, or will have a very small amount of equity allocation in their portfolio. So a hybrid product is actually a very efficient and a nice way to expose an investor to investing into equities. And over a period of time, their experience into investing, they can keep increasing the risk exposure by moving from one bucket of hybrid product to another. So if you take the pure risk return spectrum, right, debt would be at the lower end of the risk spectrum and the lower end of the return spectrum, and at the top end you would have equity. And between those two extremes, you have hybrid products, right, which starts off with the very basic of a debt hybrid, where your equity exposure is about 25%. You probably move up a notch higher to an equity savings product, which is about 35%. A multi-asset product can be about 40-45% equity. It also has the added advantage of having an exposure to an asset class such as gold. Then you can have a balanced advantage product which can have a slightly higher equity of about 50-55%, and then an equity hybrid which is at 65-70%. So for an investor who's never been into equities, you can start off with the debt hybrid and then progressively move higher as you keep meeting your investment and return guide expectations.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.